Okay, let's unpack this. Today, we're diving deep into the latest from La-Z-Boy, specifically their first quarter results for fiscal 2026. And our mission, really, it's to get straight to what's driving their future outlook. Because
Yeah.
for you, the astute observer, that's always the key story, right? Where are they headed?
Exactly. And what's interesting here is how these details from the last quarter, they don't just sit there. They directly feed into the company's forward guidance. It gives us a much clearer picture, I think, of what they expect next and maybe more importantly, how they plan to navigate it.
Absolutely. And that focus on the future, that's crucial for you listening in. So here's where it gets really interesting, like right off the bat. The company's own guidance for Q2, what are they actually projecting?
Well, Taylor Lupke, their CFO, she laid out the numbers. For Q2, they're expecting sales to land somewhere between $510 million and $530 million.
Okay.
And on the profit side, the adjusted operating margin is forecast in a range of 4.5% to 6.0%.
Right, and maybe just a quick note there on adjusted figures for you. When we say adjusted, La-Z-Boy is basically taking out certain, let's say, one-off costs, things tied to big transformations or maybe acquisitions. It just gives you a cleaner look at the core business performance.
Yeah,
We can circle back to the specifics later, but it's good to keep in mind.
definitely.
So what's the context around these Q2 numbers? Are they seeing smoother sailing ahead, or is it still pretty choppy?
Oh, it's definitely choppy. Lunicki was clear that these projections reflect, quote, continued prudent investment on strategic growth pillars.
Okay, so they're still investing for the long term.
Yes, exactly. But, and this is the key part, they're also pragmatically navigating a continued challenging consumer and macroeconomic environment. So it's not just wishful thinking. It sounds like a real balancing act between growth investment and managing these, current headwinds.
Makes sense. So how does this outlook stack up against what Wall Street was thinking for Q2? That comparison, it often tells you a lot about market sentiment, doesn't it?
It really does. It's a crucial check. So analysts on average were looking for an adjusted EPS of about $0.53 for Q2. Now, if La-Z-Boy hits their sales target and the implied profit range, that would still be a year-over-year drop in earnings, roughly 14.5%, give or take, compared to last year.
Right.
But if you zoom out a bit, look at the bigger picture, the average 12-month price target from analysts is $45. Which, compared to a recent price around $38.66, suggests potential upside of maybe 16% or so. So the immediate earnings might look a bit softer year over year, but analysts seem to still see some longer-term value there.
Right. It's easy to just look ahead, but to really understand that guidance, we need to look back at what just happened. So let's quickly unpack the Q1 results that kind of led to this point.
Absolutely. You need that context. So for Q1, the period ending July 26, 2025, total sales were $492 million. That was actually down 1% compared to the same quarter last year. And it came in just a hair below what analysts were expecting, which was $494 million.
Okay, close, but a miss.
Yeah.
In earnings.
Yeah, on earnings, the adjusted diluted EPS was $0.47. Analysts were looking for $1.55, so a wider miss there. And the adjusted operating margin for the quarter landed at 4.8%. That's a pretty noticeable dip from 6.6% last year. GAAP diluted EPS, just for completeness, was $0.44.
So sales slightly down, earnings missed estimates. How did the market take that news initially? That first reaction can be pretty telling.
It was stark. Yeah, really telling, like you said. After the earnings release, LZB stock, it dropped significantly, fell 19.82% in after-hours trading.
Wow, nearly 20%.
Yeah, that's not just a small adjustment. That's the market fundamentally reevaluating things, suggesting maybe investors see these challenges sticking around longer or hitting harder than they thought.
Exactly, and this deep dive is all about understanding the why behind those numbers and that dramatic reaction. So to get there, we need to break down the performance by segment. Let's start with retail, their own stores, right?
Right, they're company-owned La-Z-Boy furniture galleries. And here's where it gets a bit nuanced. Written sales. So customer orders placed, they were actually up 5%.
Okay, that sounds positive.
It does, but it was mainly driven by new stores they opened or acquired. The really crucial metric, written same-store sales, which looks only at established stores that actually decreased by 4%.
Ah, okay. So existing stores are seeing less business.
Exactly, and that points to what they called an increasingly challenged consumer, lower traffic, lower demand. Now, it was partly offset because the average ticket price was higher and design sales helped too, but that underlying traffic trend is, well, concerning. Delivered sales for retail actual furniture delivered were up 2% to $207 million. But the adjusted operating margin took a hit, down to 6.3% from 10.3% last year, mainly because those lower same-store sales meant fixed costs weighed heavier, plus they're still investing in opening new stores.
Got it. Growth from new stores, but pressure on the existing ones. What about the wholesale side? Supplying other retailers.
Wholesale actually held up a bit better. Sales there increased 1% to $353 million. That was mostly driven by their core North America La-Z-Boy business and their case goods, although that growth was dampened a bit by the ongoing impact of a big customer transition in their international wholesale business, something that started back in fiscal 25.
Right, so a known headwind there. What about profitability in wholesale?
That was actually a bright spot. The adjusted operating margin improved to 7.5%, up from 6.9% last year.
Oh, interesting. How?
Seems like lower warranty and marketing costs helped, plus they saw continued gross margin expansion in that core North America wholesale business. They also mentioned finishing the transition of their Arizona distribution center to a new West Coast hub, an operational win.
Okay. And the third piece, Joybird. That's their more direct-to-consumer online brand.
That's the one. Joybird had a tougher quarter. Written sales were down 14%, and delivered sales fell 20% to $28 million. Interestingly, they noted that Joybird's physical stores actually performed better than the online side of that business, and the operating loss for Joybird increased because of that lower sales volume.
So yeah, a really mixed bag across the segments. Retail challenged on same store, wholesale showing some resilience, Joybird struggling. How is the CEO, Melinda Whittington, framing all this? What's her take on the results and the path forward?
Yeah, her commentary is really helpful here. She acknowledged the good parts, pleased with wholesale's performance and the overall retail sales growth, even with the same store dip. She emphasized they have multiple levers to grow, pointing directly to that recent announcement about acquiring a 15-store network in the Southeast. That's a big move, expected to close late October.
So, leaning into acquisitions as a growth driver.
Seems like it. But she also directly addressed the margin pressure, attributing it to two things: investments in their long-term Century Vision strategy.
Which is about growing retail, expanding the brand.
Right. And second, that persistent soft industry demand. She stressed they're actively taking steps to adjust near-term operations and navigate prudently. And she really hammered home their foundational strengths, the iconic brand, their vertically integrated business model, which gives them more control over costs and supply chains.
Yeah, that vertical integration is interesting. It could be a real advantage in times like these.
Could be. And their robust balance sheet. She believes these position them to, quote, disproportionately benefit when industry tailwinds reemerge.
It's interesting that balance they're striking. Optimism for the long haul, but very realistic, pragmatic steps for today. What else are they doing specifically to strengthen the core business beyond those acquisitions and operational tweaks?
Well, a couple things stand out. They got a nice nod from Newsweek, named one of America's best retailers for 2025, and ranked #1 in furniture for the first time. That's good validation.
That's definitely a positive signal for the brand.
And speaking of brand, they formally launched a new brand identity, focused on comfort, craftsmanship. They see it as a, quote, symbol of change and a platform for growth. They also hinted at potentially tough decisions, saying they're evaluating all alternatives to address financial pressure from non-core parts of our enterprise.
Suggesting they might streamline things, maybe sell off underperforming bits.
That's how it sounds. And they're still investing in physical stores, too. Plans for fiscal 26 include opening about 15 new La-Z-Boy galleries and maybe 3 or 4 new Joybird stores.
Okay, so a lot happening strategically. Now, underpinning all this activity is the balance sheet. How healthy are they financially to support these moves and weather the storm? What about cash flow and shareholder returns?
It looked pretty solid there. At the end of Q1, they had $319 million in cash. And importantly, no external debt.
No debt is definitely a strong point.
It is. They generated $36 million in operating cash flow during the quarter. Now, that is down from $52.3 million in the same quarter last year, so that's worth noting. They put $18 million back into the business through capital expenditures, mostly for those new stores, remodels, and manufacturing upgrades, and they returned about $22 million to shareholders in Q1. That breaks down into $13 million in share buybacks and $9 million in dividends.
And just for context, how does that compare to, say, the full prior year?
Good question. For all of fiscal 2025, they generated $187 million in operating cash flow and returned a total of $113 million to shareholders. So they have a consistent track record there.
And this really raises an important question for you, the listener. When you see a company with a strong cash position, no debt, and they keep returning cash to shareholders even when things are tough.
Yeah.
How does that shape your view of their stability, their long-term potential? It's often a quiet signal, but a powerful one.
It really is. It suggests management feels confident enough about the underlying business to keep investing and reward shareholders, even with soft consumer demand.
Okay, before we wrap up, you mentioned adjusted figures earlier. Can we briefly touch on why companies use these and what La Z-Boy specifically excludes? It helps you understand the numbers better.
Sure, management uses these adjusted numbers, like adjusted operating margin or adjusted EPS, to look at what they consider the ongoing performance. It helps them compare profitability trends over time without the noise from certain items. They exclude things they feel aren't predictable or part of the core recurring business. For example, in fiscal 2026, they're excluding charges related to that distribution transformation. Think costs for closing the old center, severance, setting up the new West Coast hub. They also exclude purchase accounting charges, which are things like amortization of intangible assets that come with acquisitions. These aren't cash costs related to current operations.
Right. So it's a way to try and see the underlying engine of the business without those sort of one-off or acquisition-related effects muddying the waters. A
Mhm.
key insight for you to be aware of.
Exactly. Helps you understand the core operational health.
Okay, so let's bring it all together. What does this really mean for you, the astute observer?
La Z-Boy's Q1 clearly shows the impact of a tough consumer environment. We see it in same-store sales, we see it in Joybird's results, we see it in the margin pressure. But their forward guidance and all these strategic acquisitions, brand refresh, operational shifts, they paint a picture of a company actively investing based on their century vision while still trying to navigate these immediate challenges carefully.
Yeah, and if you connect those dots to the bigger picture, you see a company really trying to leverage its core strengths, that brand, the vertical integration, the strong balance sheet. And they're using specific levers like store expansion and that big acquisition to position themselves, not just to get through this tough patch, but potentially, as they said, to disproportionately benefit when the industry eventually turns around. Which leaves us with a really interesting question, I think. In a market like this, how much weight should you give to a company's bumpy quarterly results versus its long-term strategic bets and stated outlook? Can a company realistically invest heavily for the future while also prudently navigating right now without one inevitably compromising the other?
That's definitely something to mull over as you continue your own deep dives. Until next time.